All right, let's dive into a financial puzzle that honestly seems to defy all logic. We're talking about successful real estate investors, people with plenty of their own cash who are deliberately choosing to take out these incredibly expensive loans. It doesn't seem to add up. Or does it?
I mean, it's a fantastic question, right? If you've got the cash to just buy a property outright, why on earth would you go and pay someone else, say, 10, 12, maybe even 15% interest? It really feels like you're just lighting money on fire. But, as we're about to find out, there is a very, very specific method to this madness. And, this isn't just some theoretical debate we're having. This question comes straight from a real estate investor on Reddit who is trying to wrap their head around the American market. And just like a lot of us, they saw this huge contradiction. So what are they missing? Well, to figure that out, we've got to first understand the really unique, high-speed financial tool that's at the heart of all this.
Okay, so let's get right to it and start with a clear definition. We're talking about something called a hard money loan. And yeah, the name itself sounds kind of intense, right? A little intimidating. But the concept is actually pretty simple, and it really all boils down to one thing: what the lender cares about most. So, at its core, a hard money loan is basically a short-term bridge loan. The hard part of the name, that refers to the hard asset, the actual property that's securing the loan. And here's the key. Unlike a bank, these lenders are private folks or investment funds, and believe me, they are playing a completely different game. And the difference here, wow, it is night and day. See, a traditional bank, they care about you. They want to see your credit score, your income, your whole life story, basically. And that whole process, it takes weeks, sometimes months. A hard money lender, they care about one thing and one thing only: the property. Is the deal itself a good one? And because of that laser focus, they can greenlight a loan in a matter of days. In a hot real estate market, that kind of speed isn't just an advantage, it's a superpower.
So this brings us right to the heart of the strategy. The real reason a wealthy investor would ever pay those crazy high rates. It's all about a concept investors live by. They call it OPM, which stands for other people's money. And it might sound simple, but its effect on your potential profit is absolutely massive.
Honestly, this might be the single most important rule in the entire playbook. If you're a serious investor trying to scale a business, your own cash isn't something you just dump into one project. No way. It's a tool that you protect, that you deploy for maximum impact. You keep your cash for liquidity, for emergencies, and for leveraging it into even bigger and better things.
Okay, let's break this down with a really simple scenario, one that's based on that Reddit discussion we mentioned. Let's say you've got $400,000 in cash ready to go, and each fix and flip deal you want to do costs $200,000. So if you use your own money, you can do exactly 2 deals at once. You make a solid $70,000 profit on each. You walk away with $140,000. Hey, not bad, right? A pretty good year.
But what if we use hard money? Now the lender covers most of the cost. So that same $400,000 you have, it's not tied up. It can now be the down payment for 4 separate deals, all at the same time. Now, yeah, of course, the loan costs are going to eat into your profit on each house. Let's say you now only clear $50,000 per deal. But wait, 4 deals times $50,000 each, that's $200,000. You just made an extra $60,000 by borrowing expensive money. Now it makes sense, right? So let's just recap the logic here. It all comes down to a few key things. First, leverage, which lets you do more deals at once. Second, speed, which lets you snatch up the best properties before anyone else. And third, scale. You can grow your business way, way faster than your own cash would ever let you. And there's another big one: risk. Some of these are what you call non-recourse loans. That's just a fancy term that means if a deal goes totally sideways, the lender can only take the house. They can't touch your other personal assets. That is a huge layer of protection for the investor.
And look, this powerful logic, it hasn't just been a game changer for individual investors. Well, no, it has fueled the growth of an entire industry, transforming it from what was basically a mom-and-pop operation into a full-blown Wall Street-backed machine.
This chart right here just shows you how wild the growth has been. We're looking at something called securitization, which is really just a Wall Street term for bundling up a bunch of these hard money loans and selling them off as investments to the big guys. But just look at the numbers. The market jumped from about $200 million to over $2 billion in a single quarter. That is a massive, massive vote of confidence from the big money players.
So the entire fix and flip market we're talking about, it's estimated to be worth around $30 billion. And when you look at this chart,
Yeah, you see some big names controlling some pretty big slices of the pie. But look closer. Nearly 40% of the market is still made up of all these other smaller firms. So what does that tell you? It tells you the industry is definitely consolidating, but there's still a ton of room for the little guy, for the independent player.
And believe me, that consolidation is happening fast. This table here is just a tiny snapshot of all the mergers and acquisitions going on. You've got these huge investment firms, Aprecium or New Residential, and they are just gobbling up the largest lenders. It's like they're getting ready for a survival of the fittest showdown as the market matures. The big fish are definitely eating the smaller fish. But here's where the story takes a really interesting turn. While you've got Wall Street consolidating the industry from the top down, the very same financial tool is being used at the grassroots level for something completely different. See, hard money isn't just funding corporate house flipping, it's also funding a kind of quiet rebellion against the very systems that these big institutions represent.
I absolutely love this quote because it just perfectly captures this powerful cultural shift that's happening. Think about it. So many people are just tired of the rat race, tired of paying insane prices to live in a city. They're looking for an alternative, for a different way to live. And the thing is, traditional banks, they often won't touch that kind of dream.
So what does this new American dream actually look like on the ground? Well, it looks like people with non-traditional jobs, gig workers, entrepreneurs, getting a hard money loan approved in 10 days so they can go build a debt-free cabin in the woods. It's families buying up raw land to start homesteads. And in the process, they're bringing life back to these small, forgotten towns that the big banks wrote off years ago. It really is finance on a much more human scale.
Now, of course, it's not all sunshine and roses. This world is definitely not without its risks. In fact, the very same things that make hard money so powerful, that speed and flexibility, well, they also expose investors to some really serious challenges, especially given the economic climate we're in right now.
Right now, investors are really facing what you could call a perfect storm. You got inflation at a 40-year high, which is pushing interest rates through the roof. Global supply chain issues are making renovations take longer and cost way more. And on top of all that, after years of just red-hot growth, the housing market itself might finally be starting to cool off. For a fix and flipper working on a super tight timeline, every single one of these is a massive threat to their bottom line.
And if all that wasn't enough, then you have to deal with regulation. Take California, for example. Lawmakers there have proposed something called the Housing Speculation Act. What would it do? It would slap a massive 25% tax on any home that's sold within 3 years of being bought. A bill like that, well, it could pretty much kill the entire fix and flip model in the state overnight and send investors running for the hills.
At the end of the day, in this really high-stakes world, it all comes down to one thing: trust. I saw one source put it perfectly. They said, this is a people business disguised as finance. And it's so true. Word travels fast. If you're unreliable, if you don't do what you say you're going to do, you simply will not last. Your reputation truly is the most valuable asset you have. So we're left with this really fascinating tension, aren't we? On one hand, hard money is this brilliant tool for creating massive wealth. But on the other, it's the engine for a new, almost anti-establishment American dream. But now, with Wall Street buying up all the big lenders and regulators starting to close in, the real question becomes, who is ultimately going to control this incredibly powerful financial engine? And, more importantly, what will they decide to build with?